Good morning. This is Japanese Economic Review Channel. Today, we are reviewing yesterday's market activity from Friday, March 13th, 2026. It was a day defined by a significant geopolitical stress test. As the week came to a close, global equities grappled with the ripple effects of intensifying Middle East tensions and a sudden spike in oil prices. We will now examine how these macro shocks translated into synchronized selling across Wall Street and Tokyo during yesterday's session. The primary catalyst for yesterday's retreat was a severe energy supply shock. Reports of attacks on vessels near the Strait of Hormuz triggered immediate spikes in crude oil futures, reigniting global inflation fears. This led to a broad risk-off environment. The Nikkei 225 mirrored the contraction seen on Wall Street, closing down 633 points at 53,819, despite some afternoon dip buying that limited the downside. Yesterday's sell-off followed a clear contagion pathway. It began as a geopolitical flashpoint, which quickly turned into a commodity shock, as energy input costs were recalibrated upward across all industrial forecasts. This shifted the macroeconomic narrative towards structural inflation anxiety, raising fears that central banks might maintain high interest rates. Consequently, capital fled from macro-sensitive export equities into resource-backed safe havens. The bearish tone for yesterday's Tokyo session was set the previous night on Wall Street. On March 12th, the NY Dow dropped 739 points, its third consecutive day of decline. Industrial giants and financial hubs sensitive to global stability led the sell-off, with Goldman Sachs, Boeing, and 3M emerging as heavy drags on the index. The Nasdaq also snapped its four-day winning streak, as the tech sector buckled under rising yield expectations. Despite those massive headwinds, yesterday's reports highlighted a notable market anomaly. The mobile payment giant PayPay successfully executed its Nasdaq listing on the 12th. Offered at $16, it opened strong at $19 due to high institutional demand and closed its first day at $18.16. This performance suggested that even in a risk-off environment, there remains a sustained appetite for high-utility technology with clear growth trajectories. The Tokyo market opened in a state of retreat yesterday morning. The Nikkei 225 plummeted 1,166 points within the first few minutes of trading, hitting an intraday low of 53,286 at 9:03 a.m. However, the market found a floor as dip buyers stepped in to stabilize the free fall. By the close, losers outnumbered advancers by more than 2-to-1 on the prime market, with a total turnover of 7.63 trillion Japanese yen. A technical highlight from yesterday was the Phantom SQ. The special quotation for March Nikkei 225 futures settled at 52,909, a level 377 points lower than the cash market ever reached during actual trading hours. This indicated that while derivative-driven panic was extreme at the opening bell, it failed to materialize into sustained dumping in the cash market, where institutional support held firm. Regarding domestic resilience, the USD JPY remained relatively stable yesterday, hovering around 159.45. Interestingly, the Growth 250 index showed significant insulation from macro shocks. While names like Free declined, Timey surged on upward earnings revisions. This suggests that domestic-focused, innovative firms can act as a shield when global commodity markets are volatile. Yesterday's trading was a classic commodity hedge trade. Winners were concentrated in sectors benefiting from oil spikes, such as mining, INPEX, and non-ferrous metals, Fujikura. Conversely, the losers were those vulnerable to fuel costs and shifting rate expectations, including airlines, JAL, ANA, shipping, NYK, and the semiconductor-heavy tech sector like Tokyo Electron. Beyond the stock prices, yesterday brought news of fundamental corporate innovation. Fujikura delivered the submarine Choge to the Ministry of Defense, while Sumitomo Electric developed new home energy storage systems. In consumer goods, companies like Sharp launched new mobile hair irons. These developments remind us that industrial expansion and consumer demand remain active despite market volatility. In summary, yesterday, March 13th, acted as a real-time stress test. It proved that geopolitical fragility at energy choke points remains the apex risk for global equities. Moving forward, we see two key themes. Capital is ruthlessly efficient in rotating into inflation hedges, and domestic-focused innovation offers a viable strategy for isolating portfolios from global commodity shocks. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.